let's quickly move ahead and say hi to Pranav Gundlapalle, Senior Analyst, India Financials at Bernstein. He's with us now. Pranav, thanks for joining in. So let's start with your sort of big picture expectations, because I think everyone knows, and the issue here is that is the best behind. Now we'll start seeing credit costs rising. Eventually there might be pressure on margins, and that's showing up in the way investors are looking at financial stocks as well. Let's start with the large banks first. What could be the best, and what could be some of the worry points that you'll watch out for?
Good morning. See, I think you rightly said it's the best is behind us. I think what we are now looking for is an earnings reset, right? So we know the current level of ROA is much higher than what I would call the sustainable level. So there will be a decline in NIM, especially with a rate cut potentially coming in, and credit costs will inch up at the broader sector level. So it's not a significant deterioration that we're talking about, but still the credit cost will inch up. So yes, the ROA will decline. We've already seen the growth drop from near 16% level that we saw last year to about 11%. So overall, a weaker set of numbers with growth dipping and potentially profitability dipping as well. But that's largely priced in. So if you say where would be the surprises, I would say most of the surprises will come from the asset quality trends. While there's only been a gradual increase in credit cost, the trends have been mixed amongst the various banks. Some of them have seen a sharper rise, while others like say ICICI and HDFC have seen pretty much a flat credit cost over the last few quarters. So any variation to that trend would drive a positive or negative surprise, depending on which way the surprise comes in.
Pranav, hi, good morning. Prashant here. And good to see you back on the channel. Now, for players like, I mean, if you can sort of talk about specifics, IndusInd, for example, would you have coverage on the name, IndusInd?
Yes. So on IndusInd, for example, would be one of the banks where the West is largely priced in for the asset quality. And hence, any improvement in trends or even a clear signal that we are at the peak credit cost would be the major positive surprise to watch for, right? Whereas for others like, say, ICICI or HDFC, I think the expectation is that the current trend of almost unimpacted credit costs continue, and hence even a slight deterioration would be a big negative surprise.
So, because this has got the microfinance bit as well, so you're saying you're expecting a turn, or you're saying, well, the price, stock price is already factoring in, even if the third quarter turns out to be a poor one for IndusInd?
The stock price is factoring in the worst case. I mean, I think even if you assume they have eventually losses of well over 15% of their microfinance portfolio, even that has been priced in, with the stock trading almost at book or slightly below book in terms of forward multiples. So the worst is priced in. I think it's only a question of how long does the pain last. And in that sense, and given that MFI tends to be a shorter duration cycle, any signs that we are close to the bottom would be a positive. So nobody expects a big improvement soon, but a sign that we are at the bottom is probably good enough for this quarter.
From the banking space, is that the one that you would, because we were discussing earlier, Bernstein's sort of 11 ideas, and IndusInd is part of it. Is there anything else there?
Yeah, I think we like it because at the current valuation, like I said, the worst is priced in, and we know that the pain in MFI will be short-lived.
I was asking anything else from the financial space apart from IndusInd.
We continue to like HDFC because against the trend of ROA decline across banks, we see that as one where the ROA could remain stable or even see an improvement. So that's the other place that we would be bullish on.
Okay, you'll be bullish on HDFC Bank from these levels, is that correct?
Yes.
All right, what about PSUs, namely SBI? That stock had a one-way run, and then it's gone through a long phase of consolidation. PSUs as a basket, only they have fallen a little bit out of favor. But from the PSU basket, how do you approach it? And SBI would be top of the list?
Within the PSUs, yes, SBI would be top of the list, but we would still wait for a while for the PSUs before jumping into PSUs, because we believe the loan growth for the PSUs is still much higher than what I would call the sustainable levels. We expect their loan growth to converge with their deposit growth, which remains significantly behind the private sector peers. So to illustrate that, if you look at FY24 numbers, the PSUs were growing their deposits at 8-9%, whereas you had the private sector banks growing deposits at 17%. But when you look at the loan growth numbers, they almost were very similar. So I think that loan growth gap has to diverge. And until that plays out and the slower growth is priced in, we would remain almost neutral on SBI. No reason to jump in at this point.
Pranav, just curious, you said that you also like HDFC Bank, right? But I think in the note that Prashant was alluding to, in terms of the additions and deletions, IndusInd Bank is an addition, but HDFC Bank, I think, is a deletion. Correct me if I'm wrong.
Oh, yeah, so that, I think you're referring to the overall portfolio, where I think the factors were slightly different around the size of the bank and therefore impact on index. So as you know, for those who are looking as a standalone idea, we remain bullish on HDFC Bank. All
right. So that's one clarification out of the way. What else? We've discussed some of the larger lenders, but if we talk about asset quality issues, I mean, MFI is well documented. We know that. Any other specific names where a rise in credit costs or any sort of asset quality deterioration could be a fresh sort of worry for the market? Where else would you watch out for these trends to show up?
See, I think we think it will just continue. We don't see a scenario where it worsens significantly from the levels we saw in the last couple of quarters. So for the likes of Bajaj Finance, for example, or SBI cards, we don't see an immediate improvement in credit costs. And hence, we remain on the sidelines on both these names. But any signs of further deterioration would be a significant negative. Our assumption right now is this pain continues for a few more quarters, and therefore the growth resumption happens again after a few more quarters. So we could see the stock go sideways for a while before seeing any meaningful re-rating.
Okay, that's an important one as well, that at least it should not get any worse, maybe just stay sideways and, expect some of these lenders to pull back on growth till the asset quality issues improve. On margins, Pranav, just give us a broad big picture, because that's also a wide open debate right now, what the RBI does, how many rates, etc., given everything that's happening in the international markets. But on margins, largely, what is the kind of compression that you've started penciling in for private names, for PSUs, just across the board? What should we expect?
Right. See, I think there are two factors here. One is the rate cuts, and even if you ignore the rate cuts, there's probably going to be a slight dip in margins because you have a slowdown in unsecured growth, which used to be a big driver of margin improvement. So until the rate cuts kick in, we expect a marginal decline in NIMs, maybe about 5 basis points here or there. With the rate cuts, the private sector banks will see a sharper dip in margins. We're talking about 15 to 20 basis points dip in NIM if there is a 50 basis points of rate cut. Now, our base case assumption is for a 50 basis points of rate cut this year, which should drive between 15 to 20 basis points of NIM decline. And that number would be a lot lower for the public sector banks, maybe closer to 10 to 15 basis points. But almost all the banks will see a decline in NIMs. And in terms of rank order, IndusInd once again will stand out as probably the least impacted, just given it has a very high share of fixed rate loans. But for most of the others, the impact will be quite similar. Not a lot to drive a big preference simply based on the rate cut impact.
Pranav, do you have coverage on the MFI space?
We look at IndusInd and therefore track the others.
So that covers it, kind of. But yeah, names like Credit Access, etc., from the pure MFIs, or you think, the best way to play it is through IndusInd?
I think with pure MFIs, there are probably one or two names where you could look to gain exposure. And there again, I think our view is one, you have two paths to this whole re-rating. One is the asset quality trends where, you could probably see a bottom soon. But the second leg of re-rating will require growth to come back, which we think is at least a few quarters away. So yes, closing in towards the bottom of asset quality, but recovery in growth seems to be much further away. And hence, the extent of re-rating might not be as sharp as probably what is being expected.
All right, Pranav, we leave it there. Good conversation as always. Thank you very much for joining us and running us through the perspective on financials and as they start to report numbers for the third quarter. So it's going to be an important one.